Hi everyone. With Tesla reporting their quarterly earnings yesterday after the close, we thought we'd do a stock analysis on the company, ticker symbol TSLA. We continue to get asked by our viewers and clients what our thoughts are on Tesla, so here it is. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. So this video on Tesla shouldn't be considered a recommendation to buy or sell the stock, but we hope as we evaluate this company that for educational purposes, you'll understand a little bit better about how we think and understand the investment framework that we use here at YCG. Okay, so with that, let's dive into an analysis on Tesla. Tesla designs, develops, manufactures, and sells electric vehicles, and designs, manufactures, installs, and sells solar energy generation and energy storage products. The automotive segment includes the design, development, manufacturing, sales, and leasing of electric vehicles, as well as the sales of automotive regulatory credits. Many of their cars are familiar to you, I'm sure, but they include the Model 3, Model Y, Model S, and Model X. As of today, the company has manufactured a total of 1.6 million cars cumulatively, and in just the last quarter, in Q1 2021, Tesla announced that they manufactured about 180,000 cars, which is the most they've ever done. However, it was clear from the earnings call yesterday that Elon and the whole Tesla team continues to experience huge challenges and obstacles in the production of their mass fleet. The energy generation and storage segment of Tesla includes the design, manufacture, installation, sales, and leasing of solar energy generation and energy storage products, which include Powerwall and PowerPack. Tesla is laser focused on battery technology innovation and is working hard to solve the issue of battery efficiency, cost, and storage, and improved mileage. Autonomous driving still remains the focus for many Tesla investors, as the race for this achievement in such a highly competitive space seems to be the golden trophy that so many companies are seeking after, especially given the size of the total addressable market globally. Tesla technology is focused on radar as opposed to other competitors focused on LiDAR technology. Based on yesterday's earnings call, it seems that Tesla continues to make slow progress with the categorizing and labeling of their radar data. But make no mistake about it, this is a win for us as the consumers as we continue to see the technology disrupting and improving our standards of living. As a side note, we thought it was interesting to see the news yesterday about Lyft selling their autonomous business to Toyota for $550 million, which is such a core part of the investment thesis for owning Lyft or Uber, and now both companies have pretty much abandoned their autonomous driving plans. You don't think of Tesla and not think of Elon Musk. Elon is the chairman and CEO of Tesla and has led the company through its various stages of life ever since he invested and became involved with the business back in February 2004. But Tesla isn't the only business that Elon Musk oversees and founded. He's devoted to SpaceX, a space exploration and launching business focused on cost-effective space travel, world telecommunications, and satellite internet. The Boring Company, which focuses on significantly reducing the cost of tunneling and building out a more efficient transportation infrastructure for all members of society. OpenAI, which actively is seeking to improve machine and artificial intelligence learning. And then finally, there's Neuralink, which seeks to reduce the cost of effective prosthesis, medicinal treatments through injections, and brain-machine robotics. All of these businesses are still private, though, and are separate from Tesla, so I digress. We're here to analyze Tesla, so with that, let's switch over to Refinitiv and look at Tesla from a quantitative side of things. This is just really a basic analysis of Tesla. Unfortunately, we don't have enough time here to cover the kind of depth we go into before deciding whether it's a stock suitable for client portfolios. But nonetheless, let's take a look here at Refinitiv. Okay, so here we are in Refinitiv. We pulled up Tesla. TSLA is the ticker symbol. It was down today almost 4.5% on the earnings announcement after the close yesterday. And let's take a look at some of the numbers here. So obviously headquartered in Palo Alto in California. And let's look at, just jump right into their capital structure. So here we are, the market cap of the business right now is $708 billion. Cash equivalents is about $19.3 billion. Their debt is $11.7 billion, which is a rather large number when you take a look at their shareholders' equity at about $22 billion. Their debt is half of that, so more than half. Debt to equity is at a whopping 52%. So a lot of debt on the balance sheet. Debt to capital is at 33.14%. So let's look at some of the key ratios here. So looking at enterprise value over revenue, another kind of valuation number here in 2020 was about 21 times. 2021 forecast is at about 14 times, going down to 10 times and then 9 times in 2023. Total debt to EBITDA coverage is about 2.72 last year in 2020. And obviously as revenue grows, they're looking to reduce their debt load, forecasting to be 1.3, going down to 0.75 in 2023. The price to earnings ratio is rather steep right now. Here in 2021, it's trading at about 169 times and expected to come down at 108 to 85 times going into 2023. I will say their last quarterly earnings, pretty strong year-over-year revenue growth of 74%. And the Model 3 is now the best-selling sedan across the country, beating out BMW, which is quite an accomplishment there. So price to sales, looking at a metric about 25 times, looking to be about 14 times in 2021. Returns on equity. Well, actually, let's look at returns on assets. That's an important metric we look at. Right now, not making a return on assets, next to zero basically, but forecasted to be about 8% going into 2021. Return on equity, again, zero for 2020. Return on invested capital, been about 8.3%, expected to jump at about 22% in 2021 of this year. So here you can see the price chart. Short interest is at about 5.3%. That's significantly been reduced. Shorts have been obliterated shorting this stock. This is a terrible stock to short, in our opinion. Year-to-date performance has been about flat this year on a year-to-date basis, but if you look on a one-year chart, it's just phenomenal. Unbelievable that it was trading at $140 a share just about a year ago, and now is trading at about $704 a share. All right, so your price to earnings at an LTM valuation, very lofty at 1,158 times. So let's take a look at their revenues. So revenues historically, this last year was $31.5 billion. The forecast for the whole 2021 year, looking to achieve about $49.5 billion in revenue, growing to $64 billion in 2022 and $76 billion in 2023. Gross margin, as you know, is something that we really like to look at. It's an indication of whether the company has pricing power. Now here we look at gross margins for Tesla, been about 16% in 2019, 21% in 2020, and kind of hovering around the same, around 22%, going up to maybe 23% in 2023. The reason why we believe that gross margins is an indication of pricing power, we're trying to see if the company has the ability to charge premium prices for a similar good or service than its competitors. And what we really want to see are gross margins in the 50s to 60, even higher percent. And so this really has us questioning whether there's enduring pricing power when it comes to Tesla. Now, this is a very dynamic company with a CEO and chairman that is dynamic as well. And things can definitely change. We've seen that with Amazon as the core business has evolved into new businesses that have been a lot more profitable. And that could be done here with Tesla. I guess some scenarios that I could see where these gross margins could improve with Tesla is one, if this became an enduring luxury brand. And many people associate Tesla as a luxury brand, but I'm talking about kind of high status, like a Ferrari has that high kind of very small supply that keeps that status social signaling in place. I think with Tesla as its goal to make their EV vehicles available to the masses, I think they might have a hard time maintaining that social status of a kind of a luxury car or luxury vehicle. That being said, it could also transform where the software of the car is a language which creates high switching costs. So if someone owns a Tesla, they're used to a Tesla, the high switching costs of moving to another autonomous or electric vehicle is too high, and it builds that kind of pricing power once that Tesla has gained that market share and maintains that market share. I think the third point has to do with autonomous driving. If Tesla is able to dominate that market share and aspect and get a land grab of the most autonomous vehicles and fleets, they could be able to be in a position where they're able to advertise with their autonomous fleets and actually grow into other business segments that are much more profitable, and those margins then could increase the profitability of the business longer term. And then I think the fourth point is actually on the flip side. They actually become the lowest cost producer. So with technological advancements, they're able to produce their cars, their electric vehicle cars, at a much lower cost than their competitors, and are able to grow their margins through being the lowest cost producer. So I think there's a path for Tesla to grow its gross margins and achieve enduring pricing power through its business models. So that's enough on gross margins. Let's scroll back down. We'll keep going down here. You can see the EPS growth growing into profitability now ever since really 2019, which is fabulous to see. Institutional ownership is at about 46%, and top investors, you really have just large institutional names owning the percent of shares outstanding. Again, here Elon Musk being the CEO, and actually Robin Denholm is now the independent chairman of the board, so correction on my earlier comments there. We've mainly focused on the numbers, but calculating valuation is the easy part. If the quantitative side made you rich, there'd be a whole host of accountants and mathematicians as billionaires. If you want to learn more about our entire investment strategy, we have a video for that, and you can check out this link up here. As you can see from the quantitative side of things, Tesla is an auto and utility manufacturer, owning and supplying every aspect of the supply chain, which makes a business like this very capital intensive, similar to other auto and airline manufacturers. Now, you're probably saying that Tesla isn't just a car manufacturer. They're a technology and an AI company. And while that may be true, that doesn't change the fact that competition is ramping up, and innovation usually drives down the ability to have enduring pricing power that exceeds your cost of capital. I think what would be helpful at this point is to look at the definitive quantitative numbers again, but to put them through our YCG investment framework. I have a few slides here prepared, so let's go through this. Okay, so I prepared a few slides to show you here as we look at Tesla in the YCG framework. So here we look at competitive advantages for Tesla. There's certainly a growing global belief network that there is a social status element of owning a Tesla, and they also have some protocol and data network effects that provide the company with a competitive advantage. Is it a strong network effect? I think, if we're honest, we don't know yet. With the competition ramping up, it's difficult to know whether that network effect will continue and will be enduring. Global network effect, that's also uncertain just with the amount of competition growing globally. Whether that will be an enduring global network effect is questionable as well. And then high switching costs. Like I mentioned, I think if there's a scenario where Tesla has to compete on lowest price, then the switching costs may be reduced. But again, there's also the other side where maybe it becomes like an iPhone versus an iPhone user versus an Android. People are used to using the technology. People could get familiar and just comfortable with the Tesla software, driving software, and there's a high switching cost in moving into another vehicle with different software. And the bottom line is this is still a very early vehicle, autonomous driving, an EV manufacturer, and whether they have high switching costs remains to be seen. All right, so looking at enduring pricing power, I think right now, if you're looking at gross margins, it doesn't appear that they have enduring pricing power. Morningstar rates their moat rating very narrow, and capital allocation is standard, and fair value uncertainty very high, and obviously they're in the large cap growth category. So let's take a look at some of the Refinitiv numbers looking at Tesla here. So again, we've got trailing 12-month gross margins at 19%. They are improving, being around 22%. Operating margins are at 6%. Returns on capital employed about 7%. When you're looking at returns on invested capital, they get even worse at just around 3%. Returns on tangible assets are about 2%, and their expected return on equity is around 6%. They are building up cash, and in the last earnings announcement, Elon Musk announced that they had made over $100 million in trading Bitcoin, which is interesting. They grew their cash balance there. And so they do have some net coverage, but like I said, debt to equity is about over half the percent the company, so a lot of debt on the balance sheet. Total enterprise value is about $662 billion when you factor in that debt. And next year's revenue is estimated about $50 billion. So if you're looking at from an evaluation standpoint, so electric vehicle, enterprise value over next year's full year sales about 13.4 times, and price to next 12-month earnings, when you're looking at that, trading at 150.3 times. So would YCG consider this as an investment? I'd say at this current time, no. And the reason for that is a lot of leverage, no current profits, and it's really unclear whether there are enduring network effects and pricing power. So here's a stock comparison. Let's take a look at the shareholder yield and growth rates. This is a very simple analysis, but let's take the price of Tesla right now, $707. The next 3 years earning per share of averages to be around $5.60. And because of the capital intensity of Tesla, let's say that they pay out those earnings, about 50% of their earnings. That gives you a shareholder yield of $2.80, which really translates into a free cash flow yield of about 0.4%. Again, long-term thinking, growth rates usually come down to about 5%. So I know, obviously Tesla's growing at, 75%. But let's look into the next 30, 40 years, and growth rates probably turn to around about 5%. So let's compare apples to apples. It gives you a forward rate of return of about 6.4%. Now let's take a look at a competitor. And this might be unfair comparison because this competitor actually is in the autonomous business, but has many other business segments that are data-driven, advertising, and a lot less capital intensive or cyclical. But nonetheless, this is their share price trading at $2,200. Their expected earnings per share in the next 3 years, about $81 per share. Because of their business makeup, they actually can pay out about 80% of those earnings, which gives you a shareholder yield of $64.80 or a free cash flow yield of 2.8%. Notice the difference there, almost a 3% yield in a 0% interest rate environment. That's pretty attractive. And again, this company is growing very rapidly in the 30s, 40%. Still, even the size of the market cap of the business is extraordinarily high. So let's just apply a 5% growth looking at long term. Gives you a forward rate of return of 7.8%. So we think those kind of calculations are helpful from a comparison standpoint. This is a slide of basically our business And you can look us up here on our website at ycginvestments.com. What's interesting is if we go to this website here, companiesmarketcap.com, shows you the largest companies by market cap. The top 100 totals about $90 trillion. And pretty interesting website to look at. Here you can see Apple, Microsoft, Saudi Aramco, Amazon, Alphabet, Facebook, Tencent, and Tesla and then Alibaba and Berkshire being the 10 largest businesses in the entire world. Pretty staggering when you look at Tesla being so highly valued from a market cap standpoint. I'll point out, again, they're a high growth company. They're reinvesting in their business. So if you take a look at their earnings, Tesla actually doesn't show up in this list of having, the top 100 earnings, the bottom being Prosus at $6.4 billion. But you can kind of see these other businesses here generating in the hundreds, all the way going down to 20, $30 billion. Pretty remarkable. Revenue, and obviously Tesla's growing its revenue faster, so perhaps it will reach this point. But interesting to see kind of the biggest revenue earners, Walmart being at $560 billion, Berkshire at $391. Then you got Amazon, Apple here, CVS, Volkswagen, interestingly enough, generating $260 billion in revenue, and obviously they are fast becoming a competitor to Tesla in the EV space. Toyota here at $255 billion. Interestingly enough, Toyota actually manufactured about 10 million vehicles last year. And again, they've got that manufacturing process down. And I think Tesla will get there. I definitely think there's something to be said about having that cadence of manufacturing millions and millions of cars every month to gain those efficiencies. And Tesla's still kind of experiencing some of those bumps. But thought that was interesting to kind of take a look at the market cap of the top 100 businesses and looking at the various earnings and revenue. We love the products of Tesla and love the passion and vision they're pursuing. But looking at the current valuation of Tesla stock and the future capital requirements needed by the business to still execute on their plans, we're not as excited about the future prospects of the stock at these current prices. So what are your thoughts on Tesla? We'd love to hear your opinions in the comments section below. We currently don't own Tesla in client portfolios, and we're not short the stock either, but you can request a complete list of all securities recommended by YCG in the last 12 months by reaching out to us. Thanks for joining us today. Check out one of our other videos and we'll see you next time. Thanks for watching.